Yeah. Do you watch Love Is Blind with your wife?
Yeah,
I
I
love
have
it.
no control
I
over
love
the
it.
TV, but yeah,
Jeff probably has no idea what we're
I
talking
have
about.
no idea what you're talking about.
Yeah. I
you're
mean,
not
it's
missing much. But
you're a boomer. I mean, that's whatever.
Not even close,
No one's
but
perfect. But for Steve and I, as geriatric millennials, Love Is Blind. What'd you think?
with I was not surprised with how it turned out.
I mean, that one guy where he was like, "Yeah, my biggest concern is that I'm going to end up cheating on her." Like, what? I mean,
Then why did you get to that point to begin with? I mean,
well, yeah, it's sort of, you can think about it both ways, right? I mean, it's on the one hand, and this is sort of doing economics to Love Is Blind. On the one hand, what he's saying makes sense because is it a mature decision? I mean, yes, making a decision to go to someone and say yes at the altar after 6 weeks and saying I'm not ready. I mean, that if you think about it, yes, that makes sense. On the
not
other hand,
unreasonable.
why would you sign up for this experiment if you weren't ready to do that? Like, so, I mean, I get it, but at the same time, like, you joined the show, right? Like, so if you weren't willing to make that commitment, then you're really just getting on the show, not for love, but just to like boost your Instagram following. So I
I
guess mission
wasn't
accomplished, I guess, for that guy. Yeah,
can't fault
I mean,
anybody
Jeff,
for that.
you need to get into that show, man. I mean, I get that you're pushing like 85, but
Speaking of pushing 85, maybe that's a good segue to the State of the Union, but Jeff probably has to do the open first.
Welcome to RenMac Off Script. We open to discuss markets, economics, policy, history, and life. It's the 8th of March, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Powell.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC and our LinkedIn page. And if you like what you're hearing, but you're not an institutional investor, otherwise known as an accredited investor, join us at RenMac Access. That's renmacaccess.com. You get some insights into the latest how we're thinking and some of the data that we use to come up with our thoughts. Well, we're going to obviously hit on the State of the Union. We're going to hit on Powell. We're going to hit on payrolls. We're going to talk about productivity. We're going to talk about our market cycle clock and gold and sentiment and all this stuff. But we're going to start with payrolls because it's Payroll Friday. So, Neil, another good number. Bad news for the soft landers, right? I mean,
Good news for the soft landing.
no, I know. I mean,
I would
unless
rate this as a bullish development for the soft landing case. The initial headlines on the report skewed a little bit more hawkish, but once you peel back the onion a little bit, you see some dovish tones under the surface, and I think the doves on the FOMC are going to point to that. So number one, there were some downward revisions to the prior months. This is all very, I mean, it's very noisy, right? I think I want to put that out there. January was a noisy report. February was a noisy report. So when you have noisy data, it's best just to smooth it out and look at the 3-month trend. 3-month trend in non-farm payrolls is solid. It's 265,000 over the last 3 months. The private sector is seeing 205,000 on average over the last 3 months, which means public sector employment is running quite rapidly. Some of the things that people were worried about before are less of a concern. So breadth, remember a lot of people were talking about the breadth of employment. The payroll diffusion index, which measures that was at 62.6%. That's a reasonably strong number. So it suggests that the breadth of jobs growth is quite healthy across industries. And but the dovishness came in 2 areas. Number one, average hourly earnings. They were up just 0.1% in February. The prior month was revised down. And if you look at average hourly earnings over the last 3 months, it's just 4% at an annual rate over the last 3 months. So you had, a sharp increase in January, a big give back in February, and you look at the 3 months, 4% annualized. If you look at the last 6 months, 3.9% annualized. So, wage growth, in my opinion, is essentially consistent with the Fed's broader inflation objective of 2%. I mean, if you're assuming a 2% kind of productivity environment, which is kind of what we've gotten over the last couple of quarters, 4% wage growth is basically 2% inflation at that point, right? Because compensation growth equals inflation and productivity. And remember, if anything, the average hourly earnings data probably overstate compensation pressures to some extent, because in theory, when people bargain over their pay, they look at both wage and salaries and benefits, right? So they understand that trade-off when they're talking to their employer. And we know that benefits growth, generally speaking, has been slowing a bit more rapidly than wages and salaries over the last couple of quarters. So just something to keep in the back of your mind. The next thing is the unemployment rate. Now, the unemployment rate rose to 3.9%. That's 0.2 up from the prior month and up 0.5% from the low of 3.4%. Now, normally I would be concerned about that. I think I mean, it is important to keep watching that. And I think it's going to raise some concern. Obviously, the risk with unemployment is that it's nonlinear in nature, right? So once it goes up, the risk is that it just keeps on going up. The one thing I would say is that the rise in unemployment in February is all driven by a pickup in 16 to 24-year-olds. So not prime age workers, in other words. And there's a lot of volatility in the unemployment of 16 to 24-year-olds. So if you look at prime age workers, their unemployment rate was flat. Their employment rate was up a little bit, I believe. So I'm not really concerned about it. I don't think unemployment is kind of getting away from us. We know that layoffs are still low and hiring rates remain positive. So I wouldn't be surprised to see maybe the unemployment rate go back down. So
Do you think that's what the Bears are going to jump on, though? What are the Bears
absolutely.
going to
Look, I mean, it's a skill, frankly. I mean, I don't waste my time with it, but you know me, I always joke about it. I think it's a skill, right? Like even in the best report, you're the guy that can find the worst piece of economic information. I mean, hats off to you, but look what look at the end of the day, what matters is how is the market responding to this, and what is this likely going to do for thinking on the FOMC? And my expectation is that this probably beefs up expectations around the June rate cut. And all you're really looking for at that point is maybe a downside surprise on inflation here or there. And you're talking about a May cut at that point. So I don't think you're really that far away from it. And that's sort of where I'm at. So I think at a minimum, it just beefs up the probability that they do go in June. But it introduces some additional risk because it wouldn't take much to kind of tip the scales towards May. The labor markets, in my opinion, are not sending out an inflationary impulse anymore. I think that is the big story for me. And I mean, there was enough information in here to kind of give the doves some fodder, but there wasn't anything in here to suggest that recession is coming. I mean, think about, when you think about the Bears, I mean, I'm glad you sort of brought that up, Jeff, like, is there anything bad in this? Well, I mean, the Bears are the ones that have been talking about diffusion index. The Bears are the ones that talk about hours lead bodies, right? That's like their whole thing, like looking at the work week as a leading indicator. Well, the work week rose, right? The work week was revised up, and it rose again in February. So what then, right? And so look, I mean, what you don't want to be is someone that has a conclusion in mind first and works back. I've said that many times. I think this was a okay report, good report. It doesn't suggest that the economy is getting away from the Fed, meaning they don't need to think about not cutting at all. And I think there's enough there to kind of leave the Fed on track to be cutting this year. And at the margin, you get an inflation downside surprise between now and June. Maybe they're going in May.
Right. Well, the other big news last night was a State of the Union. I didn't watch much, but what I watched, I would say, I thought Biden was coherent and present and didn't gaffe. And I think the big concern that Democrats had would maybe, have the senior freeze, if you will. I didn't see it. What was I didn't watch the whole thing, but what was your conclusion, Steve? Maybe a couple wins on his part, and what did he leave out?
I had a football coach used to say the key to happiness is low expectations, and I think that was probably the case for Democrats last night, and the benefit to Biden. To start with what the goal was, and I think that probably is going to determine how you measure success here. And look at who watches the State of the Union. It's just a reflection of our growing polarized partisan culture. more people of the president's party tune in when the president is watching. Now, that was a concern for Biden because there'd been a lot of concerns, particularly amongst Democrats, regarding his age. So I think, to your point, he largely addressed those by avoiding, I would say, a serious gaffe. Now, you didn't stay through the whole thing. I think as time went on, there were some opportunities there, which is why I think Republicans saw what they saw, which was just, an old man who's angry and yelling and coughing and confusing his thoughts and words at times. But I think in terms of the tone of the speech, the substance, it was clearly, I think, more partisan and political than usual State of the Unions. Um, and to be fair to Biden, maybe that's because now he knows who his general election opponent's going to be earlier than usual. It did come across, though, as more of a speech that Biden would give at the Democratic National Committee. Probably didn't get into what is typically the opening line, which is what the actual State of the Union is, which he said was strong, getting stronger. Now, polls will show that a lot of people disagree with that. But yeah, I think, moving forward, what he proposed too was a lot of things that would require legislation. That's not going to happen with Republicans controlling the House. He is unlikely to have Democrat control in the Senate because Republicans have a favorable Senate map, just given that Democrats have to defend more seats, several of which are in states that Trump won. So ideas of, raising taxes, expanding the drug price dictation from CMS, that's going to require legislation, which is why I don't think that's going to happen. Doesn't hurt him to sort of lay out his wish list, but in terms of, should he be responding this from a market perspective, I think it's very unlikely. Now, that said, there are election surprises. And if Democrats do control everything, then I would be concerned in the sense that you're not going to have Senator Joe Manchin, who's retiring. You're not going to have Senator Kirsten Sinema, who's retiring. And those were the two people that prevented the removal of the filibuster, which means everything that Biden is proposing would have a chance at becoming law at that point. So that's, I think, now you should think about it, in terms of how to watch the election and sort of what he laid out.
Well, we also had Powell, and I'll let both of you talk to that. But Neil, what was your take on Powell's testimony? Was there anything that came out this week from his trip to the Hill?
I think the most notable thing in his testimony was that Senator John Kennedy of Louisiana dropped an F-bomb in an exchange with him and Powell over, I mean, Steve can maybe speak to it after, but, something about the FDIC. That to me was the most notable
Wait,
development.
was FDIC the F-bomb itself, or are we talking about the real F-bomb?
He was quoting a transcript of I think a party. I'm not exactly sure. I think that was one takeaway, and I think the I think the other takeaway for me was that Representative Rashida Tlaib from Michigan, she doesn't know how to say Ben Bernanke, even though she's a member of the House Financial Services Committee. So I thought those were two sort of things. I gave me, I'm a bipartisan type guy. Take a shot at John Kennedy, take a shot at her. So those, but no, in all seriousness, for Powell, I think what I said to our clients on Monday was basically that he was going to sound more neutral than a lot of the speakers leading up to the semi-annual monetary policy testimony. He was, and the markets took that dovishly, right? And so, and I think that's notable. And to me, the other thing that he said was that he wasn't that far from having confidence, something to that effect on the inflation front. So, that at the margin was dovish. He did kind of highlight the decline in inflation rates over the last 6 months, talking about them being as widespread and notable. So it was it was balanced, but at the margin, a little bit more to the dovish side, certainly relative to what we've been hearing out of Fed officials in recent weeks. And I think the markets kind of ran with that.
Yeah, well, our market cycle clock was out last Friday, and it's the 17th month that it's in this bullish zone. It is the relatively low inflation, low growth zone that tends to be good for equities. 17 months in a row consecutive is a record. It was breached by the 1989 string, and that was disrupted by Saddam Hussein. So, that backdrop is good. The momentum of the market clearly to the upside, seeing a little frothiness in semis. We discussed that. The way to think about that for us is that, momentum is high for semiconductors, price momentum. not a bad thing in and of itself. But what we're seeing is this buyer's frenzy, the willingness or kind of expectation for the future, better than what we've seen for the momentum in the past, leads us to believe that there are very, very high expectations at price to perfection. Excuse me. I think the weird thing in this last week, and I'd like to get your thoughts on that, Neil, is this breakout that we're seeing in gold. Dollar's not particularly weak. It looks a little vulnerable here, but gold multi-year breakout looks very, very strong. I know you're not a gold bug by any means, but any thoughts as to what might be triggering the strength of gold?
I mean, let me get my mom on the phone. The Indian woman and their affinity for gold cannot be matched. No, I mean, in all
Maybe get her
seriousness,
on. Maybe next week's podcast.
I'll get her on RenMac Legends, Jeff. How's that? No, I mean, I think it's basically a function of lower real rates. I mean, if you look at right, I mean, so if real rates
Should
come
be.
down,
They respond well to lower real rates, no doubt about it.
yeah. So I mean, I think that maybe it's part of the same trade. But I certainly don't believe that it's an inflationary development. I think that relationship between gold and actual consumer price inflation has broken down to a point where like it's not even worth making that as an argument. Gold can go up in times of deflation, it can go up in times of inflation. I mean, I don't think there's any relationship with consumer prices. I think, when I look at the market relationships, I think it's basically real rates are down, so you can add gold to your portfolio. So I think that's what's going on.
Historically, it also has a relationship to consumer confidence. So it's a little interesting that we're seeing this breakout with what appears to be an improving economy. But I think you're right. I think if we broke that down, we haven't done the math yet, but if we broke that down between, sort of composition of analysis of the factors, I would suspect that in this case, it is the contraction in real rates. What's on store next week, guys? What do you have in Washington?
Okay, I'll go. Next week, we're going to have, following Biden's State of the Union address, his budget submittal to Congress. And I think that's important to, again, through the context we sort of discussed, is in an election year, it's going to be very political. While the president proposes, Congress disposes. So I don't think most of this is going to fly with Republicans controlling the House. But it does sort of set the baseline in terms of what Congress does start to mark off in terms of their own bills with respect to spending. Keep in mind, we haven't even finished the current year's spending level. So the idea that we're looking at next year's sort of pretty telling. The other thing I would watch too, Jeff, because I know you're an avid TikTok user, is it looks like the House is going to move forward with a bill that cleared the Energy and Commerce Committee unanimously to force the divestiture there of ByteDance. It remains to be seen whether or not this will move in the Senate, where there's different legislation, but it was notable that the White House was actually working with lawmakers on the brief and that it had unanimous approval in that committee because Democrats had been divided prior to that. So whatever the White House was showing them was clearly convincing, and the fact that the House is going to move very expeditiously for them next week seems to suggest that they feel that they have the votes needed to pass that. So I just mentioned that because we have this broader concern over U.S. Relations there with China. So there's sort of two things I'm watching next week.
I don't know if I'd describe it as avid, but I'm definitely a user. That's fair. Neil, what's happening in the economic world next week?
It's going to be a pretty busy week. So we start off with CPI inflation for February. And right now, market's looking for 0.3% on core CPI. That comes after 0.4% in January. We'll see. I mean, I think what's important for people to understand is that the CPI data does not map linearly to the PCE data. But the markets are looking for some cooling in the sequential rate on core inflation. And we get retail sales as well. Remember, January was a very fluky month because for the same reason the jobs number was, right? Weather, right? Kind of kept people away. We already know that unit auto sales over the month picked up in February. So that's going to show up in the headline. And then so all we're really looking for is what's going to happen with core sales. Gas prices were up in February, so that's going to flatter the headline as well. So it's important to kind of keep an eye on that core retail sales number. What we see in the credit card spending data suggests ongoing stability in consumer spending. And then finally, we'll also get data on consumer sentiment at the end of the week. The UMich number comes out for March.
So from a market perspective, we're going to be watching sentiment. The sentiment numbers have started to crept up into the top decile of historical readings. Be a little careful with sentiment. It does have, depending on how you measure it, but it does have a statistically meaningful relationship with forward returns for equities. But most of the information content comes from extreme bearish readings, not overly bullish readings. So you can have this persistence that takes place when there are a high number of bulls before you have any type of correction. It gives us we call it a zip code indicator. It gives us an idea as to where we are within kind of the context of the mindset of the market. And clearly you want to be careful of that because it's more prone to any type of disruption or bad news. But certainly by itself as a sell signal, not terribly useful. Take a look on Twitter. We put an example of that there. We'll also be watching momentum, right? So momentum hovering right in this high 80s, 88, 89th percentile in terms of performance. We start to get nervous about the ability of the market to continue on any type of torrid pace without a meaningful correction as it gets above the 90th percentile. So it's relatively close. And again, we think the most vulnerable area there is probably in semiconductors, where you've got the expectations now meeting actually and exceeding the historical momentum. So we'll watch that. 4,800 is support on the S&P. 4,600, which is a long ways away from here, is really kind of structural support for the S&P, but the trends are still positive. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and LinkedIn. And if you want deeper insight, join us at RenMac Access. It's renmacaccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.